One AI cooling company has committed to supply more than $4 billion of equipment. The delivery window starts in 2027. The other company already reported $2.13 billion of backlog. So why could both stocks still carry real risk? Today, we compare Modine, ticker MOD, with AAON. This is not a debate about whether AI needs more cooling. It does. The real question is different. Are investors paying for demand that is already proven, or are they paying for demand that still has to survive a difficult factory ramp? By the end, we will filter this story through three tests: demand, execution, and valuation. The fresh catalyst arrived in late May. On May 26th, Modine announced a long-term capacity agreement with a strategic data center customer. Modine said it will guarantee capacity to supply more than $4 billion of Airedale cooling products. The delivery period runs from calendar 2027 through 2029. The customer also paid Modine $165 million upfront. That cash is intended to support capacity investments and related spending. Here is the important label. This is a capacity agreement. It is not revenue today. And it is not the same as a company-wide backlog balance. Earlier in May, AAON reported first quarter revenue of $596.9 million. That was up 54.3% from a year earlier. Its total backlog reached $2.129 billion. Of that amount, BASX accounted for $1.62 billion. AAON said most of that BASX backlog was tied to data center liquid cooling solutions. So here is the viewer question. Is Modine's future capacity commitment more valuable than AAON's reported backlog today? AI chips get the headlines. Cooling is the physical constraint underneath those headlines. Think about a high-density data center like a factory floor packed with engines. More computing power creates more heat. If that heat cannot be removed reliably, the equipment cannot operate at full capacity. That is where these companies fit. Modine sells thermal management equipment. Its Airedale brand serves data center cooling needs. In fiscal 2026, Modine said data center demand drove a major part of growth in its climate solutions business. AAON sells customized commercial and industrial HVAC equipment. HVAC means heating, ventilation, and air conditioning. The company operates through AAON Oklahoma, AAON Coil Products, and BASX. BASX sells data center cooling solutions, clean room products, and air handling systems. In the first quarter, the BASX operating segment recorded $135.4 million. That was up 104.5% from a year earlier. The companies overlap, but they are not identical. MOD reported $3.181 billion of sales in fiscal 2026. AAON reported $1.442 billion of sales in calendar 2025. AAON then began 2026 with faster quarterly growth. So this is not just a large company versus small company comparison. It is a comparison of two kinds of AI cooling exposure. MOD offers a large future capacity commitment. AAON offers visible backlog and a rapidly growing BASX business. Now, the numbers that matter most. Number 1, demand visibility. For MOD, the headline figure is more than $4 billion, but the label matters. This is a long-term capacity agreement. It covers equipment Modine expects to supply from 2027 through 2029. It is not the same as a reported company-wide backlog balance. The capacity still has to be built, the products still have to be delivered, and the work still has to be completed at acceptable margins. For AAON, the evidence is more immediate. Its March 31st backlog was $2.129 billion. BASX accounted for $1.62 billion of that total. That BASX backlog was up 160% from a year earlier. AAON said most BASX backlog orders were associated with data center liquid cooling. Here is the contrast. AAON has the clearer reported order book. MOD has the larger future capacity commitment. Those are both demand signals, but they are not interchangeable. Number 2. Actual revenue growth. MOD's fiscal 2026 sales rose 23% to $3.181 billion. In the fourth quarter, total sales rose 47%. Modine said fourth quarter data center sales increased 158% year over year. AAON's first quarter revenue rose 54.3% to $496.9 million. The BASX segment grew even faster. Segment sales rose 104.5% to $135.4 million. The growth is real. But there is a second question. Is this growth durable? And is the market already pricing it in? Number 3. Margins. MOD's fiscal 2026 gross margin was 23%. That was down 190 basis points from the prior year. In the fourth quarter, Climate Solutions' gross margin was 24.6%. That was down 510 basis points year over year. Management cited temporary costs from capacity expansion. It also cited tariffs, material costs, and weather-related labor and overtime pressure. AAON's first quarter gross margin was 25.1%. That was down from 26.8% a year earlier. BASX gross margin was 23.9%. AAON cited capacity investments, temporary outsourcing, and cost timing. That matters because AI demand can be strong while margins remain under pressure. Revenue growth does not automatically become earnings growth, and earnings growth does not automatically become cash flow. Number 4. Valuation. Use the following numbers as a dated snapshot. They are based on intraday market cap data from July 1, 2026. MOD's market value was about $13.23 billion. Against fiscal 2026 revenue of $3.181 billion, that was roughly 4.2 times sales. AAON's market value was about $10.03 billion. Against calendar 2025 revenue, that was roughly 7 times sales. On a reconstructed trailing 12-month revenue basis, AAON was roughly 6.2 times sales. So AAON carried the higher sales multiple. That can be justified only if backlog becomes sustained revenue and margins recover. For MOD, enterprise value divided by adjusted EBITDA was about 29 times. Adjusted EBITDA means adjusted earnings before interest, taxes, depreciation, and amortization. It is a non-GAAP measure, so it is useful as a lens. It is not a shortcut to certainty. The bull case is straightforward. First, both companies have real demand evidence. MOD has a multi-year capacity commitment and $165 million of upfront customer cash. AAON has a record total backlog, and BASX backlog grew 160% year over year. Third, both companies are adding production capacity. They are not simply talking about opportunity. Modine described its largest capacity expansion to meet data center product demand. AAON's new Memphis facility contributed to higher BASX sales. Third, management expects more growth. MOD guided for fiscal 2027 sales growth of 20 to 35%. It guided for adjusted EBITDA between $650 and $680 million. AAON raised its 2026 revenue growth guidance to 40 to 45%. AAON also targeted gross margin of 27 to 28%. But there's a catch. Those are management targets. They are not reported results. The bear case starts with one rule. A large number is not automatically a quality number. For MOD, the agreement begins in calendar 2027. MOD has not disclosed a company-wide backlog figure that can be compared directly with the contract. The customer is unnamed, and margins are under pressure during the expansion phase. There is also customer concentration risk. MOD disclosed that its largest technology customer represented about 11% of fiscal 2026 sales. Its 10 largest customers represented 49% of sales. A major customer can validate demand, but it can also increase concentration risk. For AAON, the risk is easier to see in cash and working capital. AAON reported $34 million of operating cash flow in the first quarter. Its Form 10-Q also showed $45.1 million of cash capital expenditures. That means the quarter showed negative cash flow after capital expenditures, before other investing items. AAON disclosed about $1.1 million of cash equivalents, and restricted cash combined. It also reported a $425.2 million balance on its revolving credit facility. AAON also explained that some BASX projects require upfront working capital. That can increase contract assets before cash arrives from customers. Here is the order that matters. Backlog must become revenue. Revenue must support margins, and margins must turn into cash flow. Then there is valuation. Neither stock is priced like a slow, ordinary HVAC company. If the AI data center build-out slows, the risk changes. If factory ramps take longer, the risk changes. And if margins do not recover, the multiple can fall even while revenue continues to grow. So which company has the stronger setup? AAON has the clearer demands disclosure. Its $2.129 billion backlog is a reported number. AAON also linked most BASX backlog to liquid cooling for data centers. That gives investors a more visible order book. But AAON also carried the higher sales multiple, and it had more obvious near-term working capital pressure. So the research question for AAON is simple. Can the company turn backlog into revenue, margin improvement, and cash flow? Modine offers something different. Its more than $4 billion agreement points to powerful long-term customer demand. The $165 million upfront payment adds credibility to the capacity plan. Modine also traded at a lower sales multiple than AAON in the July 1st snapshot. But the agreement is future-facing. It is not disclosed backlog. Deliveries are scheduled for 2027 through 2029, and margin recovery depends on a large manufacturing ramp. So the Modine research question is different. Can the company build enough capacity, protect margins, and convert the commitment into profitable revenue? Neither company removes execution risk. AAON offers clearer reported backlog. Modine offers a larger future capacity commitment and a lower sales multiple. Here are 4 checkpoints that can validate or weaken this theme. First, watch Modine's data center revenue and gross margins in fiscal 2027. The company is moving towards separate data centers reporting. The key test is whether capacity expansion converts into higher revenue without a persistent margin penalty. Second, watch Modine's free cash flow. Fiscal 2026 operating cash flow was $248.7 million. Company-defined free cash flow was $105.4 million after capital expenditures. The next question is whether the long-term agreement improves cash generation or requires more investment first. Third, watch AAON's backlog conversion. Track total backlog, BASX backlog, and actual sales growth together. A larger backlog matters only if deliveries continue to move. Fourth, watch AAON's gross margin and revolver balance. Management targeted gross margin of 27 to 28% for 2026. If margins improve while debt and working capital needs stabilize, the growth story becomes more durable. If they don't, the valuation becomes harder to defend. This is a classic real growth versus valuation risk setup. The demand signals are real. Modine's capacity agreement is real. AAON's backlog is real. But the market is not paying for the past. It's paying for several future years of capacity expansion, margin recovery, and cash conversion. So the research filter is simple. Research further when demand visibility expands, margins improve, and cash flow strengthens. Wait for confirmation when headline numbers grow, but factories consume more cash and margins do not recover. Avoid chasing when valuation rises faster than the proof. This is not a buy, wait, or sell call. It's a way to separate a strong theme from a crowded trade. Which number matters more to you? Modine's more than $4 billion capacity agreement or AAON's $2.13 billion backlog? And for the power side of the same AI infrastructure story, watch our comparison of Vertiv, Eaton, and Quanta next.